So people are always asking me, they know I've done quite a few flips in my life and I've also owned a lot of long-term rentals. So they always ask me, Brian, how do you know where to look? I know you own stuff in Texas. I know you own stuff in Nashville. I know you've bought a lot of stuff in SoCal. How do you know what markets to look at? So I'm going to show you very simply on how you locate markets either for one, flip opportunities, or two, long-term rentals. Now these are, once you locate these markets, then the goal is to actually evaluate different targets in those markets. So I'm going to show you how to locate a market, and then it's your job to do some research on the best deals within those markets, okay? So for flips, so when you're looking at a flip, what you want to look for is one, low days on market, meaning properties are moving very, very, very quickly, right? We want them in and out because a flip, you don't want them sitting on the market a long time. Secondly, high price disparity. So high price disparity means this. Say you're looking at something in San Diego, right? Well, let's say you have an older neighborhood in San Diego and a house is selling for 600 grand. Then 2 blocks down the street, someone's selling for 1.2 million. That's a great price disparity. Why is that so important? It means you can actually go ahead and actually improve that property quite a bit and actually close that gap. So high price disparity is a great thing because it allows you to really renovate that home within a short distance of time. If it's low price disparity, meaning pretty much everything within a couple blocks radius, you're all selling within 15 to 20% of each other, not a lot of great opportunity to really get in there, do a major renovation, and turn a flip and actually make some real profits, okay? Now, long-term rentals. Now, mind you, investment strategies are broken down two ways. One, you got flips, quick, and then you got long-term rentals, buy and holds, right? So now buy and holds, what you want is you want high days on market. Why? One, a higher day on market means there's less buyers in that market, therefore more renters typically in that market, as well as being able to likely get a little bit better of a deal in the market, right? Because there's not as much inventory that turns over as quickly. Secondly, you want to look at the gross rent multiplier. Now the gross rent multiplier, you don't want a high number, you want a low number. And what this means is basically of gross rents, a total amount of rents received on that property per year without any expenses. How long is the rents of that property going to basically pay the property off, right? How many times of annual rents are you going to have to collect that's going to pay the property off, assuming there's no vacancy or no expenses? Very simple but great formula to use. So for an example, I'll look at one. So I own a bunch of properties in Texas. So I'll just use one that I purchased, right? Bought a house out there for $275,000 in Texas, in Carrollton, Texas, where my wife's from. Now, that property rents for $1,900 a month. So what I did is I took $1,900 a month times 12 months, roughly $23,000 a year in gross rents. Take my 275, divide it by 23,000, gives me 12 years. That is my minimum factor that I will go in. So you really want anything under 13. So just to recap, when you're looking at markets to find the best investment properties in, first you need to look at, okay, am I looking to flip or am I looking for a long-term rent, right? Now if I know I want to flip, low days on market, quick turn, and giant price disparity so I can update that property to really get my maximum amount of actual equity gain in that property so I make some money when I flip it. Long-term rentals, high days on market, meaning lower buyers, lots of renters, and we want a low gross rent multiplier, something under 13. So that's how you find two fantastic markets for investment opportunities.